Welcome to another episode of Espressos with Napoleon. I am here with a business partner, Miss Daja
Lee. I got
You have
married.
gotten married now. I am here with my business partner, Miss Daja Lee. That's just how long we've been working together. Because I was working with you prior to the wedding.
Yeah.
And congratulations.
Thank you so much.
Your husband is amazing. I can't wait to beat his butt on the pickleball court.
Yes, for sure.
Before we really get into things though, I want to take a moment and give you some flowers. Tail end of the year, last year, we sat down at Monet's Cafe.
Yes.
Remember that conversation?
Yes.
Shout out to Monet. Guys, if you haven't tried Monet's Cafe, I highly recommend it. You can really taste the passion through her food. Like, she's amazing. And I'll drop a link somewhere in the comments for you to check it out. But anyway, we sat down, we kind of caught up, and what I appreciated is we got on the conversation of Myron Golden.
Yes.
I not only have watched the video.
You watched every video.
I watch him almost every single day.
Oh my God, that makes my heart like just flutter.
Let me give you a little bit of backstory. It was so nostalgic hearing his words. Growing up, I grew up under the teachings of Dr. Miles Monroe. I don't know if you ever heard of him. He was very instrumental in my life because he was one of the first pastors, evangelists that I had heard speaking entrepreneurship, growth mindset from the pulpit, and the importance of entrepreneurship. So when I heard Myron Golden speak, it took me right back to those moments as I was building my foundation. Yeah. Right? Yeah. And in addition to that, in that moment, I had just finished solving like a critical equation in my life. 2024 was a very difficult year. We talked about that a little bit at lunch. It was a tough year for me. I had, now in hindsight, realized it was a year of me identifying and understanding relationships and how relationships are built with people, how relationships are managed, relationships I have with things, and relationships I have with myself. Like, that was what I needed to just re-engage and get my compass back on track. I just want to say thank you for that.
Of course, absolutely. Thank you for seeing it for that. I was just happy to hang out with a buddy. So that was amazing. But I think it's really, really important to just have the right people at the right time come in and impart in the right ways. I appreciate that lunch meeting, and that conversation is always good catching up with you.
It was great. Thank you. Let's just start out by just telling who you are and what service you provide.
For sure. So I am Daja Lee. I'm the owner and operator of Finance Therapy Group, where we specialize in tax preparation, bookkeeping, investments, and insurance.
Nice. And you, of course, taxes is always like a very scary, or I shouldn't say always. It can feel very like a daunting situation.
Yeah. You know the word I love, like what did you say? I was going through a critical equation. Taxes to most people can seem like a critical equation. And it's really, really interesting because for me, it's extremely black and white. It's one of the plainest things that people try to complicate. And everything is in the tax code. So you don't have to necessarily complicate it, and your situation isn't special. Somebody else has experienced it, or somebody else, has won a court case behind it or lost. So you just need to make sure whatever you're doing supports whatever it is that your track record is showing.
I have some questions. I have some people in my life. We're all entrepreneurs, and we're all trying to find ways to pay the least amount of taxes possible.
Correct.
Let me clean that up a little bit. We're always just trying to find ways that we are very responsible with how we pay our taxes.
Yes.
So with that being said, a question that I had gotten: what are the most commonly overlooked tax deductions and credits that taxpayers should be aware of?
So before I get to that question, I want to specify tax avoidance is very different from tax evasion, right? So tax avoidance is to what you're speaking about. How am I going to save the most amount? How am I going to make the most of my money? How am I going to continue to grow the money that I have and not pay whatever the tax rate would be if I just hoarded all the money to myself? Tax evasion is when you are blatantly telling lies to the IRS in order to not see the number that'll just make your skin crawl. So whenever you're thinking about your tax status or your circumstance, always think, am I using methods of avoidance or evasion? Because they're very, very different. And your gut feeling will tell you when you're doing one or the other.
Yep.
If you are choosing to tip the IRS, whatever you feel like is feasible for you, then you're probably in that evasion category.
And we don't want to be there.
And you don't want to be there. But avoidance is sitting down and strategizing and investing in a tax planner to do that. So I would say some of the most overlooked deductions, especially as of late, I've been seeing are anything that's like home office or equipment related. A lot of people don't realize how much they might invest in their businesses, or even just overall into rental properties and things like that. You can't take that stuff lightly. The home office deduction, I've seen that minimized so much. So the home office deduction limitation limits you to 300 square foot within your home. I'll see a client make up a number and say 150 square foot is what I use. How do you know? Have you ever even measured it? If your home is 2,000 square feet and you're using a full room, then most likely you're pushing that 300 square foot meter, you know?
One of my offices is a home office.
For sure.
Like I have a home office that I have my desk and my, everyday usage, but I also have like a storage in my attic that I store like my files.
Yeah.
Can I also count that space as usable space for my office?
Absolutely. And I think more importantly are the things that are in that space, right? So if you have a $1,000 storage square foot, $1,000 storage cabinet or container or file cabinet or something like that, those are things that you want to depreciate on. Using any space within your business, especially if it's predominantly for business purposes, the biggest advantage you could have. Charitable donations, and one that's become my favorite are state credits that are refundable when you donate. So a lot of us will just give to random charities and we don't even really get a true advantage back from it. But when you get a statewide refundable credit, you're investing in something within your state, whether it's a school or organization, and they're basically saying at the end of the year, you just get that money right back.
Yep.
If a lot of the times we might even be investing on like flights for things or conferences or continued education, and we won't even count that as something that we can write off. Many folks are using their personal credit card or their personal debit card, and they're just forgetting at the end of the year that those were things that could be expensed from those accounts. So whomever is doing your books, and even if you're doing them yourself, just take a second and create an Excel sheet, do something to separate your personal from your business. My biggest advice for any business owner, if you start that way, it'll be so much easier to grow that way.
Yeah.
But if you start messy and co-mingling funds and, I sometimes use this card for this and sometimes use that for that, I mostly use my card for personal, but now it's tax time and I want to figure out my mileage, it gets really tricky to undo bad behavior.
All right, so next is for my individuals regarding retirement accounts. It says that, can you explain the differences in tax treatment between a 401k and a traditional IRA, and what contribution strategies do you recommend for maximizing tax benefits?
Yeah, so 401ks are designed for your company to invest in whatever other companies they absolutely believe in, right? So they might believe in a mutual fund group comprised of 200 companies or so that are extremely safe. But what that means for you is that you aren't leaving that job with $1 million in retirement, because that wasn't the objective of that growth fund, of that fund. It wasn't growth. Versus a self-directed IRA or even a traditional IRA or Roth IRA. They are all specific to, number one, your investment goals. So your mutual fund is comprised of 150 companies, 200 companies all at one time. If you prefer an aggressive growth strategy, then you're looking at some of the bigger, more booming companies, Teslas and things like that of the world.
Tech world.
Where if you are somebody that prioritizes safety, then a lot of blue chip stock and things like that are going to be within that fund. And most of it is contingent on your age, how much money you have to put in it, and where do you want to see it going in terms of growth. And just sitting down and kind of assessing that. Again, it's all about the planning. This is the year of planning for me. Like, everything should have a plan. Everything should be very clear about how you're going to get to where you want to get to. Your investment strategy should be no different. And even when we talk about the gig workers and the booming market of entrepreneurs, my favorite one right now is the SEP IRA. So, do you know much about SEP IRAs?
I don't.
Okay, I don't want to bore you.
No, I want to ingest. I'm always trying to find a way to save a dollar.
So, SEP IRAs are my absolute favorite for entrepreneurs or even just partners who, like husband and wife partnerships, because a SEP IRA allows for you to contribute up to 25% of whatever the gross income is of your company. And you're not limited to the $7,000 government max out or the $8,000 government max out if you're over the age limit. You can do 25%, and then you can reduce that from your gross income. So now you're not claiming that money on your taxes. Obviously, you pay taxes on it when you withdraw it. But if you have grown a company to $500,000 or $1 million or $2 million, and it's just you and your husband and wife who's growing that, then yeah, look into a SEP because you get so much more in advantages, which can be very different from a simple IRA. So they're very similar but different in a way. A SEP IRA, the person that owns the company is responsible for contributing to whomever is a full-time employee. That's why it's in the best interest of a husband and wife or a solopreneur. A simple IRA allows for the employee to also choose to contribute to that account if they want to, but even if they don't, the owners of the company are still 100% responsible for contributing to those IRA accounts as well. And
those are pre-tax dollars?
Correct.
And then you're just tax post whenever you withdraw.
And the benefit is on anybody that's trying to focus on that tax avoidance as opposed to tax evasion, especially when you're an entrepreneur and you forget that eventually retirement is your responsibility. And if you are a person who has not been paying into Social Security, Medicare, or Medicaid, it's going to be very, very difficult when you're 70 years old to go stand in that line and ask them for help, because there's going to be no record of you contributing to that if you're an entrepreneur who hasn't invested in payroll, who hasn't invested in your IRA, who doesn't have any retirement funds.
Yep. Arizona is becoming a tech hub, I feel. I mean, the current administration is investing so many billions of dollars in the development of chips. Apple is investing so many billions of dollars to build more infrastructure here in Arizona. With that being said, it really leans towards that Arizona is a new hotspot. You know, it's kind of unavoidable because that's the direction that we're going in. So I've really been talking a lot about investments, buying investments, and positioning my clients to start purchasing and being ready to buy investments. So with that being said, one of my clients says, well, how are capital gains and dividend tax different? And what strategies can I use to minimize my tax liability on investment income?
First of all, Napoleon's questions are amazing. So the biggest differences between capital gains and dividends is capital gains is always going to be looked at as passive and dividends is always going to be looked at as income. So on the side of it being passive, yes, it's great that you're just getting that money in and you're not doing any legwork. You're not in the day-to-day operations of whatever it took to grow it. However, you are being taxed pretty heavily because all you had to do was be a front runner in terms of money. Whereas on the income side of it, which would be the dividends perspective, you are investing in something, but you also did a little bit of legwork, which is ultimately what makes it more of an income thing for you. But the benefit to that is that there are many things that you get to offset on your income as opposed to with capital gains. Most of the time, you're only offsetting other capital gains things by negative passive income investments.
What tax benefits can I claim related to my home mortgage interest and property taxes, and how does selling my home impact my capital gain tax?
Gotcha. So this is going to be a very simple one. Most of the time, people forget how impactful it is to just claim your home mortgage interest. People will get that 1098 in the mail, and then I'll be like, hey, dude, we'll go through the checklist of all the things they received, and I'm like, oh, do you own your home? Oh yeah, did you get your home mortgage interest? Yeah, I didn't think it really counted for anything. I didn't think, no, you absolutely want to claim that. The best thing one can do is, like you said, have an investment property and be able to offset any of your actual life things with the investments that you're funneling in. So when it comes to real estate, my new favorite thing to talk about is a 1031 exchange, because it allows for you to still continue to grow your real estate portfolio without necessarily starting from scratch every single time, either on a cash heavy side of your income or just using some of your investment money and not reaping the benefit of it because it's considered a personal property. Two of the biggest misnomers is that personal property and anything that you deduct from work should be things that you can kind of offset on your taxes, and that's just simply not true. Those things are considered personal in nature. So the quicker you can turn a real estate investment into a business, the better off you'll be. And then the best thing is, or one of the greatest pieces of advice I've ever gotten was never have more than 2 homes underneath one LLC. So if you title it ABC Company, and that's just your real estate portfolio, every 2 houses that you purchase, if you have 123 Main Street and 345 Main Street, they both go under there, and then you move to creating another LLC, because when things go wrong, when things happen, when you have to pay for things, yes, you want to be able to expense those things on your taxes, but more importantly, you want to start separating you from the business of real estate as quickly as possible, so that people don't come after you. And that's important as well.
That's a real good point. Now, you spoke about 1031 exchange. Can you just give like a small little tidbit overview of what that is?
Yeah, for sure. So a 1031 exchange is when you own a home, right? And then you're trying to get out of that home to upgrade, to downgrade, to do whatever you want to do. But instead of you just outright selling it and then repurchasing a new home, you're going to pretty much exchange that home. And the difference in it is that whatever your basis was in your previous home, you aren't accumulating more of whatever that down payment is, or whatever that claim is of saying this was $1 million. I'm going from a $500,000 house to $1 million house. So now whatever that cost basis is, however much it cost me, I'm just going to continue on with whatever I put into that $500,000. And then you're not taxed on whatever that sale is that you might be receiving from the $500,000 house. So it's one of my favorite strategies I've been looking at a lot for clients as of late. And I think that it's kind of where we're going within this renter's market. Like, that's kind of what people are doing. So if you are a homeowner, or if you are a person that invests in real estate, take advantage of that. You don't need to just buy and then flip or renovate and then sell and get out of it right away without replacing it with anything first.
Absolutely. Well, this is probably where you want to dig your teeth in a little bit more on the gig world and how that works. And the question I received was, what tax obligations should freelancers or business owners be aware of, and what common deductions can they take advantage of? Yeah,
so one thing I want a lot of business owners to understand is depreciation over expenses, okay? Depreciation over expenses. I cannot stress it enough. I've seen so many times where I have a client come in and they're like, hey, Daja, I'm trying to buy a house next week. I'm trying to buy a house next month or in the next year. And I say, show me your last year's tax return. And guess what this business owner did? They made $300,000 and then they expensed $300,000. I'm sure you've seen it 100 times over more than
we can't help you when you do this. Please do not do this.
You cannot do this, right? So then they come and they say, well, I still got to buy the house. I still got to buy the building. I still got to do blah, blah, blah. How can you help me? Can we just do an amendment? And that's their quickest jump. Let's amend it. And now whatever I have to owe the IRS, I'll figure that part out later. I'll figure that out in the back end, as long as you can get me into this property. And that method, it's extremely stressful, number one. You are now putting your tax advisor, your real estate broker, your lenders back against the wall and saying, you're going to help me even though I didn't help myself. So when I say depreciation over expenses, especially when you're trying to purchase real estate or any large asset, a car for your business, anything, it's super important. You can still make $300,000 and use my new favorite thing, which is one, it's not new to tax world, but I'm just using it more within the business, 179 depreciation. So 179 or bonus depreciation. Bonus is typically for more affluent people who make a lot of money. But that 179 deduction, you are able to depreciate the cost of the things that you purchase. Like you mentioned, I have things in my storage unit, right? Well, if you have $1,000 couch or $1,000 office chair, $1,000 desk, $1,000 laptop, a $500 iPad, all of these cameras and all of this equipment, instead of you just expensing it off as one big purchase, you take depreciation on those things for the next few years, not even just in this 1 year. And then what's going to happen is you go to purchase your home, you made $300,000, you depreciated the value of those larger purchases that you had. But when they look at line 13 and I believe 31, they're going to see the correlation of, this person didn't deplete everything with these investments that they had on the front end, but they're now depreciating the value of it. So it still keeps your gross income at a place to where you can buy something.
feel like
I held that one in.
I feel like oh my God, when I tell you, I want to explore that a whole lot.
Absolutely. Look at all these cameras you have. Like,
I'm a gadget person.
Yeah.
I have a lot of gadgets and gadgets.
Yeah, and that's the thing. So the biggest things for 179 depreciation is going to be office equipment or furniture, technology, any computers, laptops, video cameras, all the things, vehicles, your vehicle depreciation, and that's outside of mileage. That's outside of you just getting gas. That's like, hey, the vehicle of this car that I use 100% for the business is going down by this much every single year. And then now, instead of you looking like you don't have any money on paper, which is what most people do first, you don't have to look like that. You can show that you've actually gained money, but because of the investments,
that's the assets.
Exactly.
The money lives in assets.
Exactly.
Absolutely.
And it's making you more money.
Guys, I'm in this bucket too, and I'm looking at you in solidarity. Educational expenses. College is expensive, was expensive, is expensive. I have a senior that's graduating next month. Congratulations,
Yay.
Boo-Boo. What deductions or credits are available for education-related expenses, and how can I best utilize them to reduce my taxable income?
Yeah. So when it comes to education, first of all, you always want to claim, if you are currently paying interest on your student loans or paying the payments for your student loans, you want to claim that student loan interest, number one. But bigger than that, always, whomever it's in the best interest of, try to see who qualifies for that American Opportunity Credit or that Lifetime Learning Credit.
What are these?
Yeah. So the American Opportunity Credit allows for you to claim your 1098-T. And if you have been in school for under the 4 years, so you haven't acquired your undergrad degree yet, then you can qualify for it based on how much tuition actually costs for you. That's the key part right there, because people will come and say, I have my 1098-T, I'm ready to file my taxes, or I have my daughter's 1098-T, I'm ready to do my taxes. And the kid was on a full ride scholarship. Congratulations to them. However, the government is not going to incentivize you for, number one, your kid already going to school for free. And then on top of that, we're going to give you $1,500 to $2,000 on top of, you already got the biggest prize.
And that's the win.
And that is the true win. So acknowledging who is this in the best interest of. There are oftentimes cases where parents, they have this like fear of not having a dependent anymore. And a lot of parents have it. It's very strange. I don't have kids, so I wouldn't know why.
I do, and I know.
You're like, I don't know what these taxes gonna look like.
You look at any possibility.
And that's the thing. People think those are the biggest advantages, and sometimes you're disadvantaging your kids by still claiming them, and really they're better off filing by themselves because now their FAFSA is contingent on their income and not yours. Sometimes it's not even a benefit to you just because you are at a certain income level, so you're not even getting the earned income credit or the child tax credit anyway. So you're just claiming them because it's out of habit and you're just used to doing it, as opposed to assessing what is the best tax planning strategy for my house. Again, that word planning. If your kid is going to school and you know that you make too much money, why are you still pressed to claim them? Let them file by themselves if they've been working full-time all year or part-time, full-time all year. If they provide their lifestyle expenses almost 100%. And if you're just a parent, that is okay. We want it to look like that on paper anyway. Because then the advantage is that now their FAFSA and the things that they're getting and the opportunities they're getting is based off of their income and not yours.
This next topic is really big in my first-time home buyer community. It's all about how they are, their filing status and how it's impacted. The question goes, how does my choice of filing status affect my overall tax rate and eligibility for certain deductions and credits?
Yeah. So one myth I want to dispel is that you have a choice on your filing status, right? So if you are married to someone, your only filing status option is married filing joint or married filing separately. You do not get to say, well, wait, I make too much money by myself, or he makes too much money by himself. One of us is going to do head of household and the other person's going to figure it out. You don't get to do that. Everybody involved in your home is impacted by the filing status that you have, especially when there are life things that are going to be hinging on your filing status, like purchasing a home. In the climate that we're in right now, a very real one has been residency status for many people who have, they're married to immigrants and things like that. Those kind of things are super duper important. So you never choose your filing status. Your filing status chooses you. And on the IRS.gov site, it literally has a calculator on there that lets you put in your information to tell you what your filing status should be. Head of household, it's a really interesting one because people will try to override it with what they believe. If you do not have any dependents, you are not head of anyone's household. You are a single person who takes care of themselves, right?
So when can you properly use head of household?
When you have a dependent.
So it's just single and a dependent.
Correct.
Not married.
You don't have to be married. Exactly.
Just
not want
single
to be.
dependent.
Yep.
Is the
If
only...
you are engaged and you have not completed any paperwork for your marriage and you have a child, you are head of household with your dependent.
Got it.
So I've had clients who come to me and they're like, I've been filing head of household, or my exemptions on my W-4 have been for head of household status. Why? It's just you. Well, because I take care of myself. No, it doesn't work that way.
In situations like that, do you have to go back and amend, or do you just kind of just correct it moving forward?
Well, amend depending on the severity. But of course, if the IRS comes knocking at your door, then that might be one of the first things you need to rectify. So what we do with a lot of our clients is after tax season, because we're a year-round tax firm, after tax season, we're following up and at least getting 15 to 30 minutes on the books with our clients saying, hey, let's review your W-4. They come to me and they have great news. Daja, I got a new promotion. I got a $20,000 bonus and all the wonderful. I'm excited for you. Let's take a look at that W-4 and make sure you have the proper exemptions. When you think of exemptions, think of it as you telling the government, this is how many people I take care of. So when that does not reflect on your tax return, they're like, hold up, we were taxing her or him at the rate of a person that takes care of 5 kids. Now you're telling me you only have 2? So you weren't paying what you were supposed to pay throughout the year.
Exactly.
So always assess your W-4 whenever you get a new job, a new promotion, that extra stream of income, you add a business to your full-time job. Make sure those taxes are able to be offset, because no one should get hit with a surprise bill at the end of the year. And filing your taxes and figuring out what you owe shouldn't feel like Russian roulette.
Yep,
it should be something that you're privy to at all times. And a quarterly check-in with your accountant, with whomever prepares your taxes. If they specialize in tax planning, then it's probably going to be the most apropos for you to sit down with them.
Tax season ends, what, next month? Or the end of tax season?
For most people, yeah. April 15th is the
I'm
deadline,
sorry.
right?
I know everything
April
about that.
15th is the tax filing deadline, so.
We have a new administration that came in. Are there any changes that we need to be aware of that you can kind of guide us through?
Yeah, I would say there's not. The tax law never really changes. I think some of the updates affect other people more than others, to be quite frank with you. Some of the biggest things to look out for is anything associated with EV credits right now are fluctuating quite heavily. There hasn't been too much change on the IRS investment side, so if you haven't maxed out your IRA, you still have time for 2024. So what I typically do is I do my contribution at the top of the year every single year, and I don't even have to worry about it, throughout. And then I just let the money sit. Now, you do want to take advantage of like the dips and the turns in the market, but if you're a person that maybe you don't do as well with $500 payments a month or $300 a month, and you just do better with that lump sum, take advantage of that, because when they change those laws on how much you can contribute and things like that, you don't want to have missed out.
What about smart homes, energy efficient homes? I know at one point there was a lot of traction around that. Are we still in that vein, or have we kind of moved out of that space now?
I would say probably more to solar, the direction of anything. I would say anything leased is probably never going to be your best bet, right? So leased solar agreements that never have a duration where you own it, I would absolutely stay away from, because on the credit side of things, it can sound like a benefit in that moment, but over time, because the tax law is constantly evolving, it's not going to be your biggest benefit if there's never an end date to you owning it.
On the leased solar piece, even from the home ownership perspective, it's not always my favorite thing to hear.
I've never heard it being somebody's favorite thing to hear. Who's in real estate.
The solar panels are leased.
Never.
Usually that means that the buyers have to qualify.
Correct.
Which means that if they're borderline, it could be impactful to their eligibility on the loan.
Yep.
So like anytime I've ever heard that there's a solar situation, the first thing I ask if it's leased, and if it is, I just kind of talk through the impacts of what a lease situation would be. Steve, and this is my personal way.
Okay.
Yeah, this is my personal situation. I'm not a really good job at the whole preparation thing and being 100% prepared when I have to sit down with you at the end of the year. I'm trying to do better, but that's just not my calling in God's way. So the question that I have is, what are the best practices for organizing my financial documents throughout the year to ensure a smooth tax preparation?
Yeah. I think the key thing that you just mentioned is throughout the year, right? Don't wait until the end of the year. And I'm probably going to say this until I'm 100 years old, still filing taxes, whatever. Do not wait until the end of the year to decide to invest in a tax planning strategy. That is something you should be investing in day one, January 1. Know who you're working with. Make sure they are a tax planning strategist. That is also important.
What are some ways that, sorry to cut you off,
Yeah.
like what are some questions we can ask, or how can we determine whether we're dealing with a tax planning strategist versus just a tax preparer?
If they emphasize a working relationship throughout the year, number one, I would ask them questions along the lines of, do you just file my taxes for compliance and just go off of the checklist of things that need to get done? Or are there any advisory benefits to working with you? Can you tell me what next steps should be if XYZ? Can you help me dig myself out of a hole and have us get to a green light at the end of this tunnel? Those are the kind of things you want to know up front, because many people, they'll say, oh, the previous person I worked with charged me $100 or $200 or whatever. And then I take a look and I'm like, oh, because all they did was file the paperwork. I get it. So look at your tax relationship. Look at your relationship with your accountant as an investment in your future. I save people hundreds of thousands of dollars throughout the year, all because we talk once a month or once a quarter. All because I'm in their business and letting them know, hey, here's what I need you to adjust. Here's what I need you to do better. People will see many things on social media, or they'll hear something from a friend and they'll forget that your tax situation is not the next person's tax situation. So while it might have been a benefit to them to file their business as an S Corp, it's just you. You don't even make enough money to qualify to keep up with the requirements of being an S corporation. Why would you do that? And make sure the person that you're working with actually knows what they're doing. Anybody, they don't have TurboTax for a reason. Anybody can go and file some taxes and hope for the best. So if you have a relationship with somebody, understand their areas of expertise. I'm very candid on what we do at my firm and what we do not do. I don't help you get into your home. I make sure you have accurate financials to constitute you getting into your home. I make sure I tell the story within your financials to constitute you getting into that next building. And then we forecast out, what does it look like for you to 10x your income? But if you're sitting down with somebody and they don't specialize in that, and that's what you're expecting of them, then you absolutely have to search for that person that specializes in that. And that's the best thing that you can do to plan. And then some things you can do for free. Wave accounting is my absolute favorite. I always say Wave is like the little sister to QuickBooks. WAVE accounting, shameless plug. Because Wave, you literally connect your bank accounts for your business and you let all of the accounts funnel in. And if you're a charts and graph kind of person, sometimes it's easier for you to connect the story of the ebbs and flows of what was going on throughout the year and where you spent all of your money. Rocket Money is also a really great one to keep up with, especially if you are subscription heavy, especially if you don't keep up with a lot of the expenses and things that come in and out of the account. And especially if you're a person that commingles funds, because then you'll start to see, like, I need some more separation between this, because now the systems I've put in place can't even keep up with what goes to what. And that's a you thing. And if you're old school, a good old fashioned Excel sheet is always the good place to start. Or join Finance Therapy Group and become a bookkeeping client. And with that, we do full scope bookkeeping. So we take on everything from pulling your statements to extracting them, to going through the query with you, to identifying how do you actually spend money and what are the things we need to see you change in order for you to accumulate more money better. Because ultimately, when you get to a certain level of wealth, it's not about how much money you make, it's about how much money you keep. And then once you keep it, it turns into how much money are you investing. And that's the part of wealth that we want our clients to get to. And unfortunately, many people, their money can come so fast sometimes. Like we're really heavy in the health and beauty space, and we're really heavy in the home care space as well. Many people, money can come in so fast that it goes out even quicker. So having that viable relationship with someone who can help you with that is going to always be most important.
Man, guys, this is why it pays to have friends that are supporting you.
I don't know if I'm smarter than
Napoleon.
This is a clear Napoleon has 3 cameras right here. So I couldn't do this.
This is a clear indication, guys, on why you have intelligent people in your network. So I appreciate your time and sharing this information with our community. Guys, we hope that we found this valuable. Daja, how can people get in contact?
Yeah, so first and foremost, thank you for having me back. I was like, oh, this is going to be good. I'm sitting with Napoleon. It's going to be amazing. But no, I super appreciate you and our relationship over this past few years and welcoming me to Arizona. So within Finance Therapy Group, again, we specialize in tax preparation, bookkeeping, insurance, and investments specific to small business owners. Check us out online, www.financetherapygroup.com, Instagram and Facebook, Finance Therapy Group. And then, set up a 15-minute consult with me, a tax pro, our CFO, our COO. Talk to somebody on our team, and we'll absolutely take you in, figure out those pain points, and help you grow.
Well, guys, there you have it. Again, thank you guys for tuning in. We hope you enjoyed this episode of Espressos with Napoleon. And until next time, guys.